We're talking about S corporations. Now, in previous discussions, we've talked about C corporations and partnerships both. Remember, C corporations file Form 1120, and an entity taxed as a partnership, right? Could be talking about general partnership, limited liability company, file Form 1065. So a completely different federal tax entity is an S corporation. Now, before we go into the specifics, the first thing I want to start off saying is once you learn about the taxation of C corporations and the taxation of partnerships, S corporations is actually very simple. Think of it like a continuum. On one side of the continuum, you have the C corporations and the consequences, right? Think about all the different types of tax issues related to life cycle of business, right? Formation, got Section 351. Operations, double taxation. You've got distribution, Section 301, redemptions, and you've got liquidation, right? 331, 332, 336, 337. So all of those rules that apply to C corporations, corporations in general. But we learned that through C corporations. On the other side, we've got partnerships. And the same issues that we talked about for C corporations, right? Forming a partnership, contributing to a partnership, flow through of items, calculating basis, liability issues, sales of partnership interest, distributions, all these things. So the question now is, where exactly does an S corporation fit? Well, an S corporation has elements of both. It's a corporation, as it suggests, but it's not identical to a C corporation for tax purposes. On the continuum, it's somewhere closer to partnership, but there are some items that make it more similar to C corporations. So in this discussion, just keep that in mind, because as we go, we're going to be looking at different rules, and what you're going to see is we're going to talk about some rules where, hey, this is very much like a C corporation. Other times it's, hey, this is very much like a partnership. So keep that in mind. All right, so now let's talk about local law. So under local law, what kind of entity you are for legal purposes, as many of you already know, is determined at the state level. Now, when it comes to corporations, there's only one type of corporation under local law, a corporation. There is no C versus S corporation. So C versus S corporation is a tax distinction, specifically a federal tax distinction. So under the federal tax law, C corporations are different than S corporations. Again, C corporations file Form 1120, S corporations file Form 1120S. And as I mentioned, there's elements that make it somewhat of a hybrid between the partnership and a C corporation. So the idea is that if you're a corporation under state law, you can either be a C corporation or S corporation, and the idea is to be an S corporation to meet certain requirements. We're going to talk about those in a moment. Before I do, I just want to mention a few things about S corporations. It's possible that you can still be treated as an S corporation for federal tax purposes and not be a corporation under local law. For example, a limited liability company, which normally is taxed as a partnership if you have more than one member, can be treated as an S corporation. You're wondering how? Well, what you would do is you would file Form 8823 you'd file the check the box form to elect to treat the LLC as a corporation, and then you would file Form 2553, and we'll talk about Form 2553 in a few minutes, where you would elect to be treated as an S corporation as long as you meet the S corporation status, those requirements. Now in later discussion, later video, we're going to talk about the advantages and disadvantages of being a S corporation over an LLC and vice versa. So you'll see that why an LLC might want to do that, why they might want to be an LLC for state law purposes, but for tax purposes they might want to be an S corporation. So we'll learn about that later. The other thing I want to mention is C corporation versus S corporation. What does the C and S mean? So the way that we do this is S stands for small business. It's that phrase. That is what the S stands for. Now, C corporation, the C just comes from subchapter C of the income tax part of the Internal Revenue Code. And the S, again meaning small business, that's actually found in subchapter S of the income tax provisions of the Internal Revenue Code. But I want to focus on the small business. In the tax law, there's lots of provisions that Congress favors small businesses. You can think of lots out there. Things like Section 179, where the limits favor small businesses, right? Small-sized businesses. Other examples that you might remember include organizational expenditures. So remember organizational expenditures for corporations, like if you're paying for attorney's fees or filing fees or accountant's fees, it's right to incorporate your corporation. In general, the rule is that you're allowed to amortize organizational expenditures over 180 months, 15 years. However, there's a carve-out where you're allowed to take $5,000 immediately when you spend it, but you can't exceed $55,000 because once you exceed $50,000, that $5,000 gets reduced dollar for dollar. So the idea is that Congress put this in place for small businesses to be able to deduct immediately versus larger businesses are going to have over $55,000. They're going to have to amortize over 180 months. So that is a benefit for small businesses. So there's lots of small business provisions out there. So keep in mind these 4 requirements that we're going to go through. Congress is trying to restrict an S corporation to smaller businesses. Now, the way it does that, you might disagree. You might be like, well, it's still possible to have a very large business in terms of dollar amounts, assets, income, those kinds of things. So they base it on really 4 criteria. The 4 criteria are number of owners, which is the first requirement, types of owners, second, classes of equity, third, and finally, ineligible corporations. We're going to talk about all 4. Before we go through all 4 of those, the last thing I want to mention about S corporations is the history of S corporations. So S corporations came about in the tax law in the late 1950s during the Eisenhower administration. So they've been around in the tax law since the 1950s. Limited liability companies have been around for legal purposes since the 1980s, 1990s, depending on the state. So S corporations have been around longer, which is why at the time of this video, there's a lot more S corporations than LLCs, but LLCs are gaining traction because the law is settled. And again, there's going to be some advantages of S corporations over LLCs, but there's also lots of advantages of LLCs over S corporations. All right, so with that, let's go into the 4 owners. The 4 limitations on who can be, what kind of entity can be an S corporation. The first limitation is the number of owners. So the number of owners can never exceed, at the time of this video, I shouldn't say never, sorry. At the time of this video, the limit is you cannot have more than 100 owners. So it's less than or equal to 100 owners. Now the reason why I conditioned myself when I mentioned that in the video is because this has changed over the years. It's been different numbers over the years. Okay? So right now, if you have more than 100 owners, guess what? You cannot have an S corporation. But that might change in the future to more owners. So keep that in mind. But there is an owner requirement. Now with this, there is specific attribution, and I like to mention the family attribution rules. And we'll see this later in my problem, so please watch the problem video. But the attribution, family attribution rule, how that works, when you're considering whether someone is considered a separate family member, you are going to treat spouses as one owner, okay? And then for family members, which spouse is family, also 6 degrees of separation. 6 degrees of separation. You're allowed 6 degrees. So what a separation is, when it comes to family members, is between a parent and a child, that's 1 degree. Between brother and sister, that's 1 degree. Okay? Between a parent and grandparent, that's 2 degrees. Because you go parent to grandparent to, child to parent to grandparent. So, sorry, I meant to say 2 levels of separation between child and grandparent. So that's how you go through and determine how many degrees there are, and you're allowed up to 6. And we'll see some examples later of going through that. So you're allowed up to 6 degrees of separation when it comes to family members, which is very liberal in terms of attribution, because you want attribution. You want to make sure you have less family members so you don't go past the 100 requirement. The types of owners. So there's only certain types of owners that can own an S corporation. Now, U.S. citizen, U.S. resident individuals, you have to be U.S. citizen, U.S. resident. Estates, trusts, certain types of tax-exempt organizations. The main thing is that you can't have really entity owners. So an owner of an S corporation cannot be a corporation, partnership, or non-U.S. person. So the key there is that you can't have an entity own an S corporation. Now, you can have the S corporation owning we call qualified S subsidiary, so qualified subsidiaries, but again, the S corporation cannot be owned by an entity, cannot be one of the owners. And again, think about what Congress is trying to do here. It's trying to restrict this to small businesses. Small businesses can be restricted by the size and number of owners, the types of owners, classes of equity is the third requirement. An S corporation can only have one class of equity, and it's with respect to distributions. You can have differences in voting rights. So knowing that means that you can never have preferred stock, because preferred stock is preferred when it comes to common, right? You always have to have common stock if you have preferred stock. It's preferred to common, and the key distinction of preferred stock is that it's preferred when it comes to distribution and liquidation. The law focuses on preference or differences when it comes to distribution, not voting. So you can have different classes of voting common stock, voting and non-common, or different classes, but you just can't have different classes of distribution when it comes to common stock. And if you have any preferred stock, you can't have an S corporation by its nature. Finally, the last one, and this is the least tested. Professors test this the least, CPA exam test this the least, ineligible corporations. So just know there's certain types of corporations out there that generally do not qualify for S corporation status. I have a list: certain financial institutions, insurance companies, etc. All right, let's talk about electing S corporation status. So the form that we use to elect S corporation status is Form 2553. And this is the form to elect S corporation status. We're going to talk in a few minutes about terminating S corporation status and revoking your termination. There's no form there. It's just going to be an election that we do on a statement. But that form is important. Now, in order to qualify to be an S corporation, you need all 4 of those requirements that we went through. Okay? To elect, you need to do it on Form 2553, and there's some other requirements. At the time of the election, so when you vote, all owners at the time of the election must unanimously agree. So we have to have 100% agreement. 100% agreement to be treated as an S corporation. Now the next requirement is that the election must be made no more than 2 months and 15 days after the beginning, not the end. First time students learn about this topic, they always confuse beginning and the end. Beginning. So what I'm saying is, let's say we start an S corporation, and we are going to be January 1st to December 31st calendar year, and we are year 1. And to make it simple, let's say that we start this corporation under state law January 1st, year 1. If we want to be an S corporation in year 1, we have to file by, count it out, 2 months and 15 days after January 1st. So January is a full month, February is a full month, and then 15 days in the next month, March 15th. We have to file by March 15th of year 1 to be treated as an S corporation in year 1. Now, if we miss that March 15th date of year 1, we can still file later, but let's say we filed after March 15th of year 1, we could then be an S corporation in year 2, but we would be a C corporation in the first year. So that's key. And no election before the existence of the corporation will be effective. Has to be after the existence of the corporation. So that is electing to be an S corporation. Form 2553, all owners at the date you're voting must agree. You got to do it within 2.5 months from the beginning of the year, or else you're pushing to the next year. What about terminating? Terminating S corporation status. So there's two ways you terminate S corporation status: voluntarily and involuntarily. Let's talk about voluntarily first. So let's say we've been an S corporation for several years and we want to terminate our S corporation status. What do we need? We only need a majority. More than 50% of the S corporation owners at the time of the voting must agree to terminate S corporation status. That's all you need. More than 50%. Now, the election's made by a specific statement. There's no specific form. A lot of elections that are done under tax law, like electing to expense capitalizable costs up to $2,500 under regulations in Section 263, the capitalization rules. There's no form to do this. You fill out a statement, put the federal identification number of the entity, put the tax year, and you explain, you put the reasons why. And you attach that to the form as a statement. This is very common, and a lot of the major tax softwares out there that do tax preparation for corporations, they give you kind of sample, boilerplate election forms statements you can use, and you just fill in the information. Okay, but it is going to be a statement that's provided, not a form. Now, if the termination is effective the first day of the tax year, the termination is due by the 15th day of the third month of that tax year. So, very similar rule to what we had for creating an S corporation or electing S corporation. Same thing. So, if we want to, let's say, 1/1 of year 4. We've been an S corporation for years 1, 2, and 3. We go into year 4 and we don't want to be an S corporation anymore. We want to terminate our S corporation status. We have to do that, and we want it to be effective as of January 1st of year 4. We have to do that by March 15th of year 4. Again, going back to our previous example. Again, 2.5 months after the beginning of that year. Now, you can terminate anytime in the future. We can say, on January 1st, year 4, we want it to be effective January 1st, year 5. It's just going back in time where it's an issue. So that is voluntary termination. Again, more than 50%. You got the dates. You have to make that statement. There's also involuntary termination. So involuntary terminations, the general rule for involuntary terminations, there's a few exceptions to this, is that if you involuntarily terminate your S corporation status, it's effective the next day. So main examples of where you have involuntary termination, let's say that you have 100 shareholders, and all of a sudden the S corporation takes on a new shareholder, you have 101. You can only have 100 at the time of this video, right? You no longer are an S corporation. You involuntarily terminate your S corporation status as of the next day where you become a C corporation. All right. So one other issue is potentially you may be able to revoke a termination. So let's say that we are going to terminate our S corporation status on January 1st, year 4, to take place January 1st, year 5. We're going to stay in S corporation in year 4, but in year 5, we're going to be a C corporation. We're going to terminate our S corporation. Well, we have this entire year where we're still an S corporation. And we have that entire year to potentially, if we want, to revoke our S corporation termination. We can revoke our S corporation termination. And so it's still possible. Again, we've decided on January 1st, year 4. If we change our mind and say, hey, we want to be an S corporation, we can change our mind as long as we do so before January 1st of year 5 when it takes place. Once you get there, it's too late. You are going to be switch over to a C corporation. But if we decide during that time, hey, we want to revoke that termination because we made a stupid decision. We don't want double taxation. We want single taxation. Then the rule is you need all owners that voted for termination and any new owners that joined since the voting. So any owner on January 1st, because remember, you only needed more than 50%, that voted for termination, and any new owners as of that date that you're voting. So let's say on, I don't know, let's pick September 1st of year 4, we vote to revoke our termination. You go to all people, all owners that voted for termination, and they are the ones that vote, and any new owners. You have to have 100% consensus. If you don't, it won't be revoked. The termination will not be revoked. So that's how you do that, okay? And that is electing, terminating, and revoking a termination, the rules for that. All right. So now let's go to the general rules with respect to S corporations, what applies, operations, and all those things. Let's go back to our continuum. Remember, on one side we have C corporation, tax treatment, and the other side we have partnership. And as I mentioned earlier, an S corporation is somewhere in between, closer to partnership. So when you're thinking about S corporations, and the main reason for that is because, remember, partnerships have one level of tax. Everything passes through to the owners. Same applies to an S corporation. It's one level of tax, and that's why when you think about an S corporation, you should start off thinking about that. Hey, everything flows through. Yes, 1120 for C Corp, partnership 1065, and an S Corp is an 1120S. So again, the main similarity between a partnership and an S corporation is one level of tax. Tax at the owner level allocated through, flows through. The 1120S and the 1065 are also very similar. Now, of course, there's some differences because, again, there's some elements that are more like a C corporation. But I would say the 1120S for the S corporation is much more similar to the 1065 than the 1120 for the corporation. So keep that in mind. When you're thinking about an S corporation, start off thinking, hey, very similar to a partnership, but there's a few things that it might be different for C Corp that are more like C corporations. Those things that are different are right here, this list. So all of those rules that you've learned about for C corporations, the general corporate rules, here are the ones that specifically apply to S corporations. So the first one is on formation. On formation, Section 351 applies to both C corporations and S corporations and all those rules that accompany. So remember Section 351, right? On formation or contribution to a corporation, shareholder is giving up property, right? You have to have a transfer of property to a corporation solely in exchange for stock, and such person or persons are in control of the corporation, which is 80% or more. So S corporation follows that suit, not partnership where you don't need a control requirement. So that's the first thing. Second thing, distributions. On a distribution, remember that for C corporations, when a distribution occurs, if the C corporation distributes appreciated property, right, the fair market value is more than the adjusted basis, then the C corporation had to recognize a gain. Same thing with S corporation. Now the gain flows through to the owners, doesn't get taxed at the S corporation level, it flows through to the owners in general, but there's still that element we calculate gain. We're going to see that in an example, a problem later on. Also, redemptions. The Section 302 redemption rules apply to S corporations as well. So the 4 requirements, right? You got the substantially disproportionate, you got the complete termination, you got partial liquidation, and you've got not essentially equivalent to a dividend, NEED, need. Liquidation. The liquidation rules apply to S corporations just like they did for C corporations, 331, 336. Finally, reorgs. Reorganization rules apply to S corporations. We haven't talked about that because it's a basic discussion in our previous videos, but just know reorganization rules, they apply to both C and S corporations. All right. Keeping in mind, again, that S corporations were starting off with the understanding that, hey, S corporations are pass-through entities like partnerships. Okay, keeping that in mind, we keep that idea intact. and we have the flow through, right? Flow through of corporate income and loss. So the items flow through. And just like on the 1065, the 1120S, on Schedule K, right? Page 1, we're going to have our ordinary business income loss, just like the 1065. And we do that also on the 1120. But we also have the separately stated items. And we have the same logic for why we have separately stated and bottom line lumped together items, ordinary business income loss items on page 1. Same logic as a partnership. Not the exact same treatment, but the same logic where you need it separately stated because you have differences in the taxpayers. So that also applies. So very similar. And remember the partners, they get a K1. In 1065, they also get a K1 for 1120S. The difference in the form is that a K1 for 1065 is called 1065 K1, and then for 1120S is 1120S K1, which do have a little bit of differences. Now, here is one major difference between an S corporation and a partnership. And also, just so you know, I have a video I mentioned it earlier that goes through the distinctions between S corporations and partnerships when choice of entity. I highly recommend looking at that video after this video. So one huge benefit of a partnership is flexibility, the ability to allocate income gains, losses, deductions very flexibly, as long as you follow book, as long as you follow the economics. Substantial economic effect, we call it. For a S corporation, that is not the case. And the reason is, again, remember what S stands for? Small business corporation. And another way to help you remember is that S, also you can think of it as simple. Congress says, hey, small businesses should be simple. You got, a plumber. You've got an auto mechanic. Should be a simple business, simple structure. You don't got crazy venture capitalists, going out there and funding this like you do of C corporations, maybe LLCs. Small business. We're giving these benefits to small businesses, and we're not trying to give them to the large businesses that need the crazy funding, venture capital funding and all that good stuff. So when you think of S, obviously you mean small business, but also think of simple. So when we allocate income, deductions, losses, profits, all those things, we always use for an S corporation the shareholder's pro rata share of any item of income, loss, deduction, and we base this on the number of shares. So we base it on the number of shares owned during the year. So I have a little example here of Lemon and Lime. They own all the stock equally, right? So one half of Citrus Corp. The entity incurs a $60,000 loss during the year, non-leap year, so 365 days, because we do a daily approach when we allocate. On the 200th day of the year, Lemon sells one half of her stock to her son, Meyer. How much of the $60,000 loss, if any, is allocated to Lemon? So we take the $60,000 loss, we multiply that by Lemon's share because, again, we do everything pro rata based on how much you own. But we also have to take the number of days that Lemon owned because Lemon did not own it the entire amount. So 200 out over 365 days. So Lemon is allocated a $16,438 loss on Lemon's K1. So not too bad. Okay, so now let's go on to corporate level tax and very limited circumstances. So again, the general rule is that S corporations have one level of tax. However, there are some unique situations where an S corporation is subject to double taxation, just like a C corporation. Now, this is a very advanced topic for S corporations. This is meant to be a basic overview of S corporation tax. So I'm just going to give you the gist and talk about two general examples of this tax, of this special when you get double taxation, where the S corporation has to pay one level of tax and the owner pays the other level, right? Before we talk about those two types, which we're going to call the built-in gains tax and the passive investment income tax on S corporations, that's what they're known as, there's some common themes that you're going to see when it comes to double taxation of S corporations. The only time you can have double taxation, again, it's very rare, but you can have it, is when the S corporation at some point has been a C corporation, or it's been a C corporation, it's acquired property from a C corporation, and the basis was determined in reference to a C corporation. So usually that means some type of a related party transaction or event, or brother sister entity. And or. So these are all or. Or it has a accumulated C corporation earnings and profits. So that one you'd have to be a C corporation as well. So there's the key theme is that there's some type of C corporation activity before, or you've done business with a C corporation through related activity. And the idea there is anti-abuse. Usually where you see this happens is an entity starts off as a C corporation, and then it becomes an S corporation later on down the road. And why? Because it wants to avoid double taxation, because maybe it's going to liquidate, or it has lots of appreciation built up. We call it built-in gains. Congress says, no, that's too good to be true. Anti-abuse rule. We're going to put in a double taxation, a deemed double taxation, if you're trying to take advantage and be a C corporation, and then now you're trying to get out without having to pay double taxation as a C corporation. Because that's one advantage of being a C corporation over being a pass-through entity, is that C corporation, at the time of this video, 21% tax rate. But the highest ordinary income tax rate at the time of this video is 37%. So you can save 16% in taxes by putting your business through a C corporation and just accumulated earnings. But the kicker is that if you later sell your business or you sell property, you're going to hit with double taxation on the appreciation and the distribution of the property. Huge tax on the C corporation. So what some businesses would do is they would form as a C corporation, get that 21% tax benefit rather than 37%, the highest bracket, allocated out to the owners, right? So you're saving 16% in taxes, and then later try to transfer over to an S corporation and then get hit with just one tax and try to play games. But Congress stopped the games by putting in these special corporate level taxes on S corporations. So the first one is called the built-in gains in section 1374. And this one, what you see is usually, again, you start off as a C corporation and you've held property, it's appreciated since it's been a C corporation. Now, if it's only appreciated since you're an S corporation, don't really have to worry about it. Now, the CPA exam, my exam, other professors out there, they usually focus on the conceptual aspects of these rules. So just understand the general idea. Passive investment, 1375, that's another tax that focuses on passive investment. This one has some crazy calculations. The other one does too. I'm not going to get into the crazy calculations. Just to show you an example for those people that are tax people out there, if you want to take a look and see how this works, you can look at an example of what exactly you do, how you calculate, and all that good stuff. Now, these two taxes are referred to as sting taxes. And the reason they're called sting taxes is like a bee sting. You could just be doing your normal business operations, not even selling off property, not even doing anything crazy, where you normally would find these types of taxes. And then all of a sudden, you get hit with this second level of tax. So that's why it's called the sting tax. Think of it like a bee sting. Just when you least expect it, bee comes up and stings you, and you don't know what happened. All right, let's go into loss deductibility limitations. So again, the main thing I want you to focus on when you're thinking about S corporations in this video is after you've gone through partnerships. And if you haven't, that's one thing I should mention earlier in the video, is if you haven't gone through the partnership taxation yet, I highly recommend to stop the video right now, go back and look at my partnership tax, basic tax video for partnerships to get an idea of the taxation there. But once you have an idea of partnership tax, you should be thinking about that with differences. We talked about how there's differences for C Corps, right? How we carve those out. There's going to be some other differences, and I'm going to mention them in a moment. But when it comes to loss deductibility limitations, we have the same general deductibility limitations on losses. So the question is, okay, we saw earlier, for example, Lemon. Lemon was allocated a part of the $60,000 loss. Can Lemon actually take that on his or her return, right? Actually take advantage of that loss? And the answer is you have to go through the loss deductibility limitations. So there's actually 4. I have 3 listed here. The fourth one is section 461L. We'll talk about that last. But you go in order. You always go in order. The starting point is the adjusted basis in the stock. And I'm also going to put in there and the adjusted basis in the loan. And we're going to talk about that in a few minutes, but you're going to see there's special rules for stock and loan basis of an S corporation. Okay, we keep them separate, and I'll explain why. So that's the first stop. So it's very similar to partnership loss limitations. The second stop is the at-risk rules. So just like for the partnership, at-risk rules, basically you have to be at risk with respect to your investment. This was put in place because people were borrowing money non-recourse, and then they would be able to get benefits. So this stopped a lot of tax shelters. The third rule is 469 passive activity loss rules, also put in place to stop tax shelters. What it does is it breaks up your activities into active, passive, and portfolio baskets. If you have a loss from a passive activity, you can only offset your loss from the passive activity with passive income from other activities. For active income, you can do the same with active, but it has to be active with active, passive with passive, portfolio with portfolio. So you lump them together. And finally, the last one, this is a new one from the Tax Cuts and Jobs Act. Well, new at the time of this video. You might be watching this in the future. It might not be new anymore. And the one here is there's a $250,000 loss limitation, or $500,000 if you're married filing joint. And you can only take up to that amount. Now, everything in these limitations that you can't take gets carried over to the next year where you continue. And then when you dispose of the activity, guess what? You can actually utilize that, with the exception of $250,000 and $500,000. That you just have to keep carrying forward, going forward. That's a weird rule. All right, calculating basis and the effect of liabilities. So again, probably getting sick of me saying this, but when you're thinking about S corporations, your starting point is to think about the partnership tax rules. Now, one thing you might remember is that in the partnership tax rules, section 705, we calculate the adjusted basis of the stock going forward each year. And we do the same thing for S corporations in the stock. We take the basis at the beginning of the year, we increase it for income and gains, we decrease it for deductions and losses, right? We also increase for non-taxable income, tax-exempt income, decrease it for non-deductible items. And then at the end, we do distributions last, always. Just like we do with partnerships. So we take into account. So this is the same thing. There is one major difference, though, and that's what we're going to focus on pretty much the rest of our discussion. Because we're going to have some examples that are going to break this down. Remember, for partnerships, any portion, or not any, the portion of liabilities that the partnership, the partner is responsible for with respect to the partnership gets added into the basis. So partner includes his or its share of liabilities in the adjusted basis. For an S corporation, that's not the case. For an S corporation, no, we don't do that. Why? Think about state law. A corporation under state law is a separate legal entity. It's separate from the owners, separate and distinct. It is think of it as a separate being. Versus a partnership, like a sole proprietorship, is actually made up of the owners. It's like a flow through, pass through of the owners, a conduit of the owners. Okay? So S corporation, we don't add in any liabilities in the basis. There is one exception to this rule, though. You do need to know this. If a shareholder directly loans money to the S corp, you get a basis in your loan. And you can use this loan basis, just like your stock basis, when you're determining how much loss you can take. But you're going to see you cannot use it for distributions. That's key. So you can use this adjusted basis for losses, but not the tax effect of distributions. Okay? So this is what we have here. If a shareholder has loaned money, we're going to have two bases. We're going to have the basis of the stock and the basis of the loan. two bases that the shareholder has that we need to keep track of, because if there's a loss, we keep track of both of those. That means we're going to have ordering rules, because if we apply, right, the increases and decreases to the basis, right, we increase for income, decrease for deductions and losses. The question is, well, which basis is the increase or decrease first? So, ordering rules. Shareholder losses and deductions reduce personal loan basis and stock basis in the following order. First, when we have a loss, we first reduce stock down to 0. Then we reduce the loan down to 0. If we get down to 0 for both, we can't take any of the loss, and this is a mechanism that's in place where it stops the basis to go where it can't go below 0. Now I have a little example here, and this is an important example. So let's say we have year 1. And by the way, it's going to continue to year 2, so keep in mind that it's a continuing example. In year 1, a shareholder has an adjusted basis of $20 in S Corporation stock and $10 in a personal loan to the same S Corporation. The face value of the loan is $10. Now, face value, by the way, is always what limits it, the face value. The S Corporation allocates the shareholder $27 of loss or deductions during the year. The adjusted bases are reduced in the following order. So we have $27 of loss. So the rule is, first, we reduce the stock. We've got 20, so we reduce the first 20. We've got 7 left. So the stock then, the adjusted basis is now equal to 0. So now, second, the next, we have 7 left. We have a 10 basis in the loan. So the next 7 goes to the loan. That leaves us with an adjusted basis in the loan equal to how much? 3. And guess what? All $27 of loss is good to go in terms of our limitations. We just have to go to the next limitation. Right? So we're looking at the top limitation, the adjusted basis limitation. We're allowed to take into account both for the loss limitation. Well, here's another issue. What if you have income or gain or make a contribution, where that would normally increase the basis? What's the order? Well, first, it's the reverse order. First, we increase the loan up to the face value. And then second, we increase the stock, and stock can go infinite. It can go infinitely positive. So let's continue with our example. Right? We just reduced our basis all the way down to, well, the stock basis is 0, loan basis is 3, right? That's the end. And all 27 of the loss can be taken under the first hurdle. Then we go to at risk next. What if we have in year 2, $52 of income allocated to the owner? Okay, we've got $52 of income. We start with the loan. Now, here's the key. The loan adjusted basis starts off at 3. The face value of the loan is 10. So we can go up by 7. So we bring the basis to 10. Adjusted basis goes from 3 to 10. We have 45 left. And all 45 gets allocated to the stock, because our basis was 0 in year 1 at the end. Now our basis in the stock, our adjusted basis equals 45. So again, when you're reducing basis for loss, the order is stock first, then loan, both down to 0, then you can't go past anymore. And then it's a reversed order for when you increase. All right, so that's when you have a loss. What about if you have distributions? Okay, so there's some special scenarios that make key differences when it comes to the ordering rule. They include shares of stock sold at a later date, all or portion, and distributions. We're going to talk about the distribution issue. So distributions, and I have the summary right here, are very similar to partnerships, where, hey, if you receive a distribution of cash, we saw with distributions of partnerships that if your distribution exceeds your basis, you've got capital gain on that amount, right? Unless it's hot assets and it's a complex distribution. But for S corporations, it also includes the fair market value of property, which is not the case for partnerships. Another difference when it comes to partnership and S corporation. But the rule is we first reduce the shareholders' basis in stock and we ignore the loan. So when it comes to distributions, we do not consider the adjusted basis of the loan. So if there's any basis in the loan, we have to ignore it. But there are some quirky rules, so you'll see it might affect things. And then after that, if we use up all the basis in the stock, then we're going to have gain with respect to the sale or exchange of shares. So that's going to be capital gain, right? Long-term or short-term, depending on how long you hold your stock. So there's some special rules to consider. So that's the general rule. Special rule. The first special rule is, what if your distribution is greater than or equal to your earnings or income during the year? We're just going to say income allocated to you. Well, if that is the case, then what you're going to do is you're going to subtract the two numbers to get the net distribution, and you're going to apply the net distribution rule to what you have here. So it's all about the ordering. If you were to increase the basis and do this and that, you would have different results. What we do is we take a net result. I'll show you how to do this. So here's an example. These are two independent scenarios. On January 2nd, year 1, Mango, who's a sole shareholder, loans his S corporation $10,000. By the end of year 1, the stock basis Mango has is 0, and the basis in the loan or note is $8,000. During year 2, the company's operating income is $10,000. The company makes year 2 distributions of $11,000. Calculate the consequences. So the distribution in this example is $11,000. The income, so it's greater than or equal to $8,000, yes. So the rule is we're going to net the two. We're going to take $11K minus $8K. We get $3,000. We call this a net distribution. We apply the net distribution rules we just learned, our Rule 1 and Rule 2. So we have a $3,000 net distribution, okay? I'm sorry, my apologies. I took the 8,000. That should be 11,000. See? Make some mistakes there. My apologies. So that actually, we're going to go back. It's actually 1,000. My apologies. Because the amount of income is $10,000. This is 10,000. So 11,000 minus 10,000 is $1,000. So we apply our rules. Now our stock adjusted basis is 0. So there's nothing in step 1. So guess what? All $1,000 is considered a long-term capital gain because it's between 2 years, right? So it's held for more than a year. All distributions for S corporations are deemed to occur on the last day of the tax year. So we have a $1,000 long-term capital gain to the shareholder, and that's in step 2 of what we just did, right? Step 1 and step 2. All right. What if the distribution amount is less than the income allocated, the earnings allocated? So in this example, so it's a completely separate example, we have, again, a 0 basis in the stock and an $8,000 basis in the note. During year 2, the company's operating income is $11,000, an $8,000 distribution. So the distribution is $8,000, which is less than the $11,000 of income. So the rule is we're going to net, we're going to subtract these amounts. So we net just like we did the other ones. So we take $11,000 minus $8,000 and we get $3,000. Then we apply this is the income, right? This is net income. We're going to apply the normal increase rules for loan and stock. So remember, the way it works is first we allocate to the loan. So we increase the loan first. That's the rule. We increase the loan up to a face value. The face value is $10,000. The adjusted basis we're given the problem is $8,000. So we're allowed to go up. This difference, of course, is $2,000. So we're allowed to increase, right, by $2,000 to bring our adjusted basis to $10,000. So we had $3,000 net income. We give the first two to the loan because we need to get to the face value. Then the remaining $1,000 goes to the stock. And then the stock's adjusted basis at the end of the year equals $1,000. And that's how you go through that analysis. So last thing, and then we're done with this discussion, is I want to talk about two other examples when it comes to distributions. So number one, during the year, Blueberry, sole shareholder of calendar year S Corporation, received distribution of $16,000. So we have a distribution of $16,000. At the end of last year, the stock basis was $4,000. The corporation earned $11,000 of income. It has no accumulated earnings and profits. So note the first thing, no loan. No loan here. If you have no loan, it's a lot easier. You apply the rules like you learned them back in partnership land. So what does that mean? We start with the adjusted basis at the beginning of the stock, which is $4,000. We go in order. It's all about ordering, just like we do with partnerships. We're going to increase for the $11,000 of ordinary income, because remember, distributions are always taken into account last. We increase and decrease for income and losses. So we do the $11,000 increase for the income. That brings our basis, our new basis, to $15,000. Now, last, we do the distribution. So distribution, we have a $16,000 distribution, right? We reduce our basis. The adjusted basis is now equal to 0 because we reduce it down, and that leaves us $1,000. Uh-oh, you can't have negative, right? So we're going to have a $1,000 capital gain, right? $1,000 capital gain, right? Long term if held for more than a year, short term if a year or less. And that is how you address that answer. So the answer is the basis is 0. We've got a $1,000 capital gain and a $15,000 return of capital. Problem 2. Cherry is a sole shareholder of an S corporation. At the time when her stock basis is $20,000, the corporation distributes appreciated property worth $100,000, basis of $20,000. Cherry's taxable gain is. Okay, so, and I also want to consider the consequences of Cherry beyond the taxable gain. All right. Remember, this is one of the rules that, hey, we're looking at S corporations, partnership, C corp, right? Very similar. All right? This is one of those rules that we actually have to apply the S corporation more similar to a C corp. So remember, for C corporations, we had 4 steps for distributions. The first step was when you distribute property, right? Step 1, we take the amount realized minus the adjusted basis. The amount realized is the greater of the fair market value of the property or the liability relief. There's no liability relief here. So the property being distributed is this appreciated property with a value of $100,000. That's the fair market value, minus the adjusted basis the corporation has, which is $20,000. We have $80,000 of gain. The S corporation has to record on its 1120S Schedule K. That $80,000 gain all goes to Cherry as a sole shareholder on the K1. So yes, the corporation doesn't pay tax on it. It flows through, but it does make a difference when you compare to partnership. I'll explain at the end. So that goes through. We also are going to apply step 2 like we did back in the EMP, but we do it to basis. So what we're going to do is we're told Cherry's basis in the stock is $20,000. We just have an $80,000 gain. Gains increase basis, like income. So we're going to increase by the $80,000. Cherry's new adjusted basis in the stock before the distribution is $100,000. Finally, we take into account the distribution. Then we've got the distribution. Now, distribution for S corporations can be either property or cash that you take into account for gain. For a partnership, that's not the case. So the distribution, we use the value of the property, which is $100,000. We subtract that away, and that brings our adjusted basis in the stock down to 0. And guess what? None of the distribution is taxable. So there was a tax on the sale by the corporation allocated out, $80,000. There's no tax on the distribution, and then there's a basis in the stock remaining to Cherry of 0 because all of it's used up. Now, that is the consequences of the Cherry and the corporation. One thing I want to notice, if this was a partnership distribution, would we have the same consequences? No. If you go and you look at the partnership distribution problems or the partnership basics, the distribution discussion, what you'll see is that, let's assume that the appreciated property is a 1231 asset. So it's a tier 3 asset. We got no tier 1, right, cash, no tier 2 ordinary income assets being distributed. Tier 3, we have the 1231 appreciated property. Guess what? Partnership distribution, no, and if it's simple, which we're going to assume here, no consequences to the partnership, no gain or loss. To the partner, since we have no tier 1 or no tier 2, tier 3, right, we're not going to have capital gain or capital loss. Okay? It's going to be no gain or loss. We just give the basis of $20,000 to the land. Or the 1231 asset, I should say. Let's assume it's land, 1231 land. It's going to get allocated. So it would give you different consequences. And I talk about this, by the way, in the choice of entity video. All right, so that sums up the discussion of S corporations. I hope you've enjoyed this discussion. Please look at the S corporation problems as well.